Hey traders! In this video, I'm going to reveal one of the most important concepts that you need to understand as a trader, and it's called smart money concept. Whether you're a beginner or an expert, understanding this concept is vital for profitability as it gives us insights into how major institutions like the big banks actually trade the market. So, let's begin. But first, if you've traded before, I'm sure most of you have encountered this exact problem. So you look at a chart and you've identified a support level based on past rejections. Then, as the price approaches that level, you anticipate that another rejection will occur, which leads you to open a buy position with a stop loss placed slightly below that support level. Surprisingly, the price did not reverse as expected, but rather breaks through the support level hitting your stop loss, only for the price to rebound in the direction that you initially predicted. Now, for most of you that experience this, I'm sure you'll find it really frustrating. But what most traders don't know is that this is actually a common manipulation tactic that the smart money use to control prices and steal profits from retail traders like us. And so, who are these smart money exactly? Smart money are actually investors that have large sums of money. Think of it like the big banks, institutions, or hedge funds. And so, because these investors have a large amount of capital to trade, they are actually the ones moving the market. Meaning, if we're able to somehow figure out their way of thinking, or even better, knowing what their trading strategy is, we can use it to our own advantage and make a profit. And so, with that being said, here are several smart money concepts that you must follow in order to increase your win rate as a trader. Smart money concept number 1. Supply and demand areas. One of the key concepts to understanding how smart money works is supply and demand areas. Supply and demand are levels that show a significant amount of money is coming in or out at that one particular price range. This can also be referred to as liquidity zones, as it indicates the presence of liquidity, suggesting that institutional traders or smart money may enter or exit at these price levels. In the future, these areas can then be used as key levels to help us identify trade opportunities. Here's one example. So in this chart, we can see here that the price pushed upwards, indicating that there are more buyers than sellers at this level, meaning the demand at this level exceeds supply, which is why the price went up. And so because of that, we can actually draw a demand zone at this level, right before the price went up. Next, as the price approaches the demand level once again, supply and demand traders can use this same key level as a possible buy entry, because price tends to react to these supply and demand levels. And so if the price were to rebound upwards after hitting the level, they would have made a profit. This is just one example on how traders could capitalize on the supply and demand zones. Now, I'm sure some of you would notice, this works a lot like support and resistance levels. And you are correct, they are similar. And so the question is, what's the difference between support and resistance and supply and demand? This is a question that people still often get confused. So the answer to that is how they form. Let's first start with support and resistance. Support and resistance forms when price retests a level with a minimum of 2 times. For example, so in this chart, we can see that price went up, goes down. Then, it went up again, hits the previous level, and comes back down. And so because it already retested the level twice, we can call this a resistance level. Same thing with support. Here, we can see price went down, goes up, comes back down again, hits the level, and went up. And again, because it retested the level twice, we can call it a support level. Now, let's compare that to how supply and demand levels form. So, in this chart, we can see that price went up, as shown by this big green candle, indicating that there's liquidity coming in at this level and that demand exceeds supply. Because of this alone, we can draw a demand zone at this level. And that's it. It's that simple. We just have to find an area where price moved significantly. Same thing with supply level. So here, we can see that supply clearly exceeds demand, as shown by price heading downwards after hitting this level, which means that smart money or big institutions are selling heavily at this price level. Because of this, we can immediately draw a supply level here. Now in the future, price may actually react to this level and retest it. Like in this example, we can see that price hits this level and reverse downwards. And so, because price have now retested this level twice, the supply level now becomes a resistance level. So to summarize, supply and demand levels are actually just support and resistance levels that hasn't been retested yet. Now, let's move on to smart money concept number 2, which is market structure. To put it simply, market structure is the concept of understanding the behavior, condition, and direction of the current market. Let's look at this chart as an example. But first, what do you think is the market structure of this chart? Is it an uptrend, downtrend, or sideways? Now, I'm sure most of you will answer uptrend because the price is going up. And if you did, you're correct. This is in fact an uptrend. However, the reason that this particular market is considered an uptrend is not because it's just simply heading upwards, but it's because of the market structure. If you look closely at the movement of the market, we can see that it kept forming what's called a higher highs and higher lows. Here's what that means. First, price moved upwards, comes back down, but remains above the previous lows of the price. Next, we can see it went up and surpasses the previous highs, forming higher highs. After that, it came back down, remains above the previous lows, goes up and breaks above the previous highs, forming another higher highs, hence the term higher highs and higher lows. Now, this breaking of the previous highs is also referred to as break of structure. And the same concept works for downtrends as well. In this chart, we can see that the price is forming lower highs and lower lows, while also creating a break of structure towards the downside, hence why this market is identified as a downtrend. So, once you've understood the concept of market structure, it's time to move on to smart money concept number 3, which is called change of character. To put it simply, change of character is when price violates the previous market structure. Usually, this may be a sign that the overall trend is changing. Let's look at an example. So in this chart, we can see that the price is forming lower highs and lower lows, indicating a downtrend. However, at some point, we can see that after the price formed lower lows here, price went up, but this time, it managed to break above the previous highs at this point. Notice that before, price always managed to stay below the previous highs, but this time, it broke above it. And this is what we call a change of character. And as seen in this example, after the price broke the previous highs, it went down, remained above the previous lows, went up, and broke above the previous highs. So now we have a break of structure that formed after a change of character. And because of this, it is now confirmed that the market structure has transitioned from a downtrend to an uptrend. Now, one of the main reasons on why understanding market structure is so important is so that we could actually identify the appropriate positions to take, because we only take positions that are aligned with the current structure. So, if the market structure is bullish, then we're looking to take buy positions only. And if the market structure is bearish, we're looking to take sell positions only. So, now that we've mastered all the essential smart money concepts, let's see how we could implement this into our trading strategy. So, the first step in our trading strategy is we need to identify a trend. Now, let's look at this chart here. We can see that price goes up, makes a pullback, but managed to remain above the previous lows. Next, it went up, creating a break of structure and forming higher highs. And after that, price went down, remains above the previous lows, comes back up, and made another break of structure and forming higher highs. So now we have higher highs and higher lows, which is a characteristic of an uptrend. Now, once we found the trend, the next step is deciding when to enter a trade. So, for our entry strategy, we first need to analyze the chart itself. We can begin by drawing important key levels that exist in the chart. And in this case, we can immediately see that there are a couple of supply and demand areas that we can draw. First, we can see a couple of demand levels right here, here, and here, as we can see price heading upwards after hitting those levels, indicating strong demand. Next, we can also spot a couple of important supply levels. We have one right here and here. Now, once we've identified all the key supply and demand levels at this price range, we can finally search for an entry signal. But first, because the market structure indicates an uptrend, it means that we're strictly taking buy positions only. So we know that at these zones that we drew, high liquidity is present, meaning that there's a chance that price may retest those levels again in the future. So let's see what happens to the price. Alright, so we can see that the price made a pullback and entered a demand zone right here. So now, we're looking to see if the price retests this level. And to do that, we need to wait for extra confirmation. And in this case, we can actually spot a bullish engulfing pattern, which is a candlestick pattern where a red candle appears, followed by a larger green candle that engulfs the previous candle. This confirms us that there is bullish momentum happening as price touches the demand level. So, let's recap what we have currently. First, we have an uptrend as shown by the market structure, which means that we're only looking for a buy entry. Second, we've identified multiple supply and demand zones. And third, we have a bullish engulfing pattern that formed as price hits our latest demand zone. And so I'm confident in taking a buy position right here. Now, I'm gonna let the trades run. And as you can see, this setup gave us a nice win. Let's look at other variations of this setup. So again, the first step is finding and identifying a trend. And in this chart, we can actually see that price initially created higher highs and higher lows, indicating that the market is initially on an uptrend. However, we noticed that a change of character has happened, as price went down, breaking below the previous lows, forming lower lows. This shows us that the market is now on a downtrend, meaning we're looking to take sell positions only. Now, once we've identified the trend, the next step is analyzing the chart by drawing the key levels. And here, we can actually spot a couple of supply and demand levels, which shows that there is high liquidity at those areas, which caused the price to move significantly. Now, let's see what happens to the price. So, we can see here that price approaches this first supply level. However, it doesn't mean that it will automatically retest this level. We need further confirmation. And in this case, price actually ignored this level and simply break right through. Now, had you taken a sell position here without any confirmation, you would have ended up losing. That's why extra confirmation is important before taking a trade. Next, we have price hitting another supply level up here. But this time, we can actually spot a bearish pin bar pattern right here as price approached the level, which is characterized by a candle having a small body and a long wick towards the upside, which signals downward rejection. And so, because a bearish confirmation signal appeared as price touches the level, we can now take a short position right here. For our stop loss, we can place it just slightly above the supply area and place our profit target at the nearest demand level. And as you can see, this trade ended up being profitable. Now keep in mind, all the trades that I showed you are just examples where the trade succeeded. If you implement this strategy in a real chart, you will suffer some losses, because no strategy is 100% accurate. That's why risk management and placing a proper stop loss is very important. And that's the end of our lesson for today. Thank you so much for watching. If you like this video, consider subscribing to the channel. It only takes 2 clicks, but it means so much to me. And you can also check out my other videos as well. Until next time.